All right, everybody. Welcome to this evening's presentation. We have a really cool investment opportunity here for Elite 100 members. But before we get going, obviously, you got to read the Riot Act of a disclaimer. As always, anybody in the Matrix Success Networks, we're not certified planners, advisors, or analysts, or economists, nor are we CPAs or accountants or legal profession. What we're doing here, we're not finance professionals or endorsing anything here. We're looking at something for educational purposes, and we're looking at it the same way as you guys are. That being said, it is something that when I saw it, I was blown away. So looking for you guys to use your expertise. A lot of you are real estate experts, along with Kyle and the gentleman here sharing this today. So without further ado, I will hand the thing over to Norm, who you guys met the other day. And I'll give you a screen share, bud, because this is going to be an in-depth deep dive. So let me go ahead and do that. And there you go. And everybody here was on the other day, so they know you. They got the 5-10 minute pitch. So if you want to just dive into it, and if you guys want to hold your questions, write them down till the end. We can do that, and we'll do a Q&A at the end.
Awesome. Thanks, Brian, for allowing me to share this with your group and the people who showed up tonight. Thanks for being here. I'm going to try to get through the pitch deck as succinctly as possible and as smoothly as possible, and I'm sure I'm going to leave plenty of time for questions towards the end. This is our website. I'm just going to show you how easy it is to get to this as a point of reference. It's listid.us, listid.us. And if you go to the homepage here and click invest, it'll take you to our fund page. And on the right-hand side here, you'll see some of our legal documents, cut sheet, PPM, our safe agreement, operating, and subscription. But the pitch deck is what we're going to go through here. And that's pretty easy to get to. Hopefully, I can get through this in a not a speedy fashion, but in a fashion such that you guys get it, and I'm not spending too much time beating you over the head with the details. All right. So we're going to start just with the investment up front so that I can give you guys a quick glance of what you'd be participating in as an investor. And what we're doing is we've set up a limited partnership. The goal here is to raise $10 million in seed capital that we hope to return between 6 and 12 months. Okay, so this isn't like you're throwing your money into a venture and never seeing it again. Hopefully you'll be made whole within 6 to 12 months. During that time, you'll get a 7.5% preferred return on outstanding capital. And in exchange, we're going to offer 10% future equity in the company via safe agreements. In addition, we'll be making monthly distributions equal to 10% of earnings. And the 5-year average on that will be a monthly disbursement of $224,000. And again, that $10 million that we raise will be collateralized one-to-one by residential real estate. So in the event that something were to happen, you do have that. The some quick metrics, just the IRR at 88%, the MOIC or multiple on invested capital of 2.4. Anything over 2, I think, is for something with this type of risk is pretty good. Net present value and some of these others are basically based on some of our financial projections, which I'll show you right in the next slide, but also towards the end. If we were to raise the capital here, the 10% equity would be worth after year 1, 1.5, and then ongoing, 9 million, 25, 58, and then in year 5, hopefully 143 million. That, again, based on financial projections, assuming we can deliver on everything that we project to do. And as you'll see, that 10 million, wouldn't necessarily value itself in the equity up until somewhere between year 2 and 3. But again, you're going to be getting your capital back on this investment, so it's not like it's outstanding. As towards the company aspect of things, I'll try to move quickly through some of these easier slides. The problem that we're focusing on for the buyer, and Kyle can speak to this to no end, and some of the frustrations and struggles for not only first-time home buyers, but really any home buyer with prices where they're at these days. affordability and the debt burden. So affordability is pretty straightforward. It's tough to afford a home unless you have one to sell. It's tough to get in and start building some equity in a home, given that barrier to entry of just really, really high prices. And then the debt burden, right? So not only having that ball and chain around your ankle, but also the interest that accrues, and we all know how debt can saddle you in lots of different ways throughout life. The real estate investor is another side of this marketplace, right? We have the buyers, and I'll explain to you where these guys come in. But real estate investors, whether you're the average Joe who has a couple, $100 extra bucks every month to invest in something like real estate, or if you're a professional, maybe a money manager or a portfolio manager with who knows, hundreds of millions of dollars. There's the time aspect, right? Of if you want to purchase real estate, usually you have to hold these, 7 to 10 years on average, in order to make it, whether it's liquid or realize any appreciation. The cost basically obviously is a big one. You can't really, spend $100 on real estate unless you wanted to get into a REIT or a fund, which are becoming more popular. But we'll explain some of the problems there. And then middlemen, right? If you are investing in a REIT or a fund, but they're managing the properties, they're picking the properties, they're all kinds of overhead and expenses in the middle, and they're taking their cut basically. So what we see as the solution is equity financing, and this is not something new. Sometimes some of the most brilliant ideas, the ones that are in front of us every day, and we just don't see it, and we go, "Oh my gosh, why didn't I think of that?" And this is like I was explaining the other day, something pretty straightforward and simple, right? If you don't have the money to purchase something, you can either go into debt, right, to acquire that capital and make the purchase, or if you're starting a company, you don't have that money to start the company. One way that is done every day is you sell equity, right? Very similar to what we're doing. And what we see is taking that principle of selling the equity and basically finding and partnering people with others that want to share in that investment. So as you'll see here, the breakdown is hypothetical, right? The buyer has their 20% down payment. Listid comes in with the other 80% in cash. Okay, we would purchase the property in cash, therefore there is no debt. That's really important. I think that's one of our principles that we want to drive here is hopefully shifting people away from the traditional 30-year mortgage and banking and debt, and getting them into something that makes sense for them and doesn't burden them, and then allows them some flexibility. So the buyer would own their 20%, or as much as they put down. It could be more than that. In exchange, they would make monthly payments that are anticipated to be half the size of a mortgage payment. The buyer can purchase back equity from us over time. That's subject to certain terms and conditions, but there's that flexibility we're talking about. The monthly payment being cut in half automatically makes this a huge either money saver for somebody, or it increases their buying power, right? If I have a $5,000 mortgage payment, and that now has become $2,400 a month, obviously you can see that, I can put that capital to use in different ways. And I could use that also to purchase equity back, if I can afford the entire payment, hypothetically. And we would own 80% of it, and take that and we would turn it into securities. And those securities trade similar to bonds, right? They are priced initially pegged to the 10-year treasury at the time of origination. And those are tradable after a period of 1 year. So if you're an investor and you want some exposure to real estate, these are a great way to get in. They again trade similar to bonds, right? They have some assurance. They're backed by a physical asset, and you're going to get that fixed portion, right? That 3.5%, which is what about the 10 years at today, or just under that, 3.4. So you're going to get that fixed portion on a monthly basis, but then you're also going to see some of that appreciation, and you can realize that before the normal term of a real estate investment. So you don't have to wait the 7 or 10 years to cash in on any sort of appreciation that might happen with the asset. Any questions, or can I keep rolling through this?
Oh, you're good. I was just coughing. Sorry.
Okay.
I do have a
So I'm just gonna keep powering through, and hopefully we can get to them at the end here. The monthly payment hypothetical here, $500,000 property with 20% down. Your mortgage payment, depending on if you have good credit, who knows, with this new program that's rolling out with the new administration or current administration that's putting forth the new program. But hypothetical 7%. Your taxes, insurance, and no PMI. Obviously, if you have up to 20% or more, 3,200. If you're looking at using us, that monthly fee of call it 3.5%, maybe lower given the 10-year right now. Your taxes, insurance, the same. We have a transfer agent fee, a renovation fund, which I'll explain a little bit, and then a servicing fee. But again, cutting that cost basically in half. And another hypothetical real quick, if they were 10% down, now you're talking about call it 450 in PMI on the mortgage side, which brings your cost up to about 4,000 a month, and with us down to 2,100 a month. A timeline real quick when we can come back to this when there might be questions, but again, hypothetical 123 Equity Drive. Jim, who we'll see in a minute here, creates a bid, and he wants to buy a $500,000 property with 20% down, and his monthly payment is $1,900. So from bid, we then go to the purchase, where we form a series within an LLC. We close on the property very quickly and efficiently. The next would be monthly payments that are ongoing, and then the ability to trade the securities on the market, and then finally liquidation, which I will get to here in the next slide. So this is the one that kind of makes sense to everybody, right? So hypothetical, you're 500,000, buyer has 100,000 in, we have 400,000 in. Let's say the asset appreciates 50%. So a $750,000 sale of the asset. That would mean that the buyer nets their 150,000, and our securities would equal out to 600,000. If the property value were to go down in that scenario, the depreciation comes from the buyer first. So part of the benefit of these, part of the trade-off for having these fantastic low, half the cost monthly payments, is you're giving up some of the upside. And if there is some depreciation in the home, you are going to take that hit first. We don't love that, but I mean, there needs to be some skin in the game here for the people who are owning and operating these properties, and hopefully down the line living in these as owner occupied. So in that scenario, 50,000 would be shaved off the top from the loss in the property, and then the investor is still made whole. And then again, in a really bad situation where it would go down by 25% and the home sells for 375,000, all of that buyer's down payment would be wiped out, and now the investor would first now start to take a loss. So when you think about some of the worst scenarios in real estate over the years, and obviously 2008 when I was going through college and found out pretty quickly it was going to be an interesting couple of years majoring in finance. You think back to that time and the market correction and prices, depending on what metric you look at, it was in the 30+% drawdown on a lot of home values, and a lot more in a lot of scenarios. But even in that type of scenario, you're, as an investor in these securities, these bond-like investment products, you're really not going to see a loss until you take one of these huge drawdowns. So it is safe in terms of it has that safety of a bond, but with some risk and some upside potential as well. So to dig in a little bit on the buyers, we have a pretty basic platform. Initially, we're going to start out with our partner, Kyle Seabeth, who you guys know, but obviously a very, very established and accomplished professional in not only the state of Rhode Island and Massachusetts, but nationwide. And we'll be using a lot of people and buyers that we have already reached out to, we've already connected with, and have relationships with that are excited about this product and are high credit, high income individuals with a track record of success. And these will be owner occupied, non-owner occupied to start. So going forward, I'm trying to think if there's anything else I missed here on this Yep, the buyer custodian can increase their equity by monthly overpayments or decrease it by missed payments. So that's the flexibility we were talking about a little bit earlier. An example here, this is Jim. Jim wants to buy a 123 Equity Drive and rent it out. He has 100,000 for a down payment of 20%. He retains all of the traditional ownership rights. He owns 20% of this series LLC that we've created, but for all intents and purposes on the day-to-day, he's functioning as the owner of the property. Let's say he can rent it for $5,000 a month, mortgage of $3,200 a month, basically leaves him with $1,700. If you were to use us now, all of a sudden that $1,900 or $3,200 cost is now $1,900, and he's looking at almost doubling, or not almost, but at least $1,300 extra there in monthly revenue. So the value proposition for guys like Jim, hypothetically, is pretty strong, since they're not so worried about asset appreciation on the back end, which is what they're giving up a little bit, but their monthly cash flow is just really, really increased and improved. So the impact here for buyers like Jim is potentially, if we can drive down cost, we can increase Jim's revenue at the same time as making rent cheaper for renters. This is just a non-owner occupied example. I think after we get through this first phase, we plan on targeting owner occupied when we get there. To keep this moving, the investment product. So I want to just make sure that we're distincting between an investment in Listid, the company, and an investment in our investment product, two totally different things. We're here discussing the investment in the company, but part of what our company is turning out is this investment product for mostly professionals, but eventually, even non-accredited down the line. So your average retail investor. But initially targeting professional portfolio managers, some of which I have a lot of direct connections with, but guys with a couple $100 million maybe assets under management, and they want a portion of their portfolio to be in something safe, gives them exposure to real estate, but like we talked about with REITs, and we'll talk about in a second, you're capturing as much of the cash flow as possible. So this is an example here, but I don't want to let this go too long. I'm going to keep it moving. A really quick glance of the product, like as we talked about, that downside protection. Okay, so if the property stays the same at zero, you're still going to get your dividend, or we're calling it that monthly payment cash flow each month. So you can see there at the investment value of $400,000. Even if the property doesn't increase from zero down to about 20% or 23%, you're still going to have some sort of positive income. You're not going to lose any value of your investment until you get down to the 23, 24% depreciation in the asset. And then the upside obviously includes the appreciation plus your monthly cash flow. Just a quick comparison.
Norm, can I pop in for 1 second?
Of course, Kyle.
So, guys, the reason why this is super attractive, and the big problem we talked about the other day, is number one, right now at this moment we're putting out at 20% down, but we're working toward getting as low as 5% down for very, very solid buyers that have great track records. That's number one, that your capital is one of the biggest problems that people face when they go into real estate investing, that they don't have the 25% to keep rolling over and over and over again, but yet they have the wherewithal, they have the buying power, they have the ability to manage the properties, and they have the background and history of managing multi-capital. But the second most important thing is you have a big issue sometimes with interest rates and with other expenses, where people believe on paper multifamily investments really derive a ton of income, when in reality, when you break down the actual numbers, they're not as income heavy as you would think. So what this does is it solves that problem by basically cutting in half your mortgage payment with this dividend payment, and allowing you to cash flow based upon what you're actually paying out in dividends. So it gives you a way to barbell your strategy as far as, hey, I may have 10 properties, 5 of which I may own the conventional way, or I put 25% down, I pay down my debt, I have a ton of equity, I also have a lot of appreciation based on when I bought them. But at the end of the day, they don't cash flow very well. But now the 5 that I bought through Listed, these 5 cash flow really, really well because of the strategy that I put in place. So there is a huge opportunity for this. And this is going to stay away from owner occupied as long as we can, because I just know that, localized and on national level, how important it is to have some sort of product like this for investors that are qualified and investors that deserve to be able to purchase with less money down and have a lower payment. So that's one of the key factors that when I got involved and got on board was one of the big drivers. And I already have investors lining up to be the first ones to utilize the first 20 or 40 properties that we do, because they can't wait to, they're licking their chops, getting ready to go to buy a 10 unit for $1 million with 20% down and cash flow with half the interest rate. So with half the dividend payment. So just to understand, like from my mindset on the real estate side, it makes a ton of sense and really creates fills a big void that's in the real estate market.
Absolutely. Kyle just articulated probably better than I could on some of those points. And like he spoke to, that down payment is really a big hurdle for a lot of people. As this scales, right, and you can see the flexibility that might exist. But let's say somebody has, they don't have, the 20%, maybe they have 5 or 10%, but they have great credit. There's a sliding scale that we could work with there, and all of a sudden that monthly payment, they're willing to make a higher than a 3.5% minimum monthly payment, and we can lock them in at a higher monthly payment, but give them, that 5 or 10% down. But initially here, I want to focus on the fact that Kyle pointed out, which is non-owner occupied. These are professionals, people who know what they're doing, that we have relationships with, to get this thing rolled out, and we can talk all day about the possibilities for this as it grows, and as an alternative to a mortgage. But yeah, that was really well put, Kyle. The snapshot we're looking at here is just quick side by side. The S&P, obviously, you're looking at your 10%-ish returns, but you don't have any insurance. You lose what you lose. And there is some inflation insurance kind of built in there, right? Like inflation kind of affects all assets, but especially financial assets first. And the 10-year treasury, 3.5, obviously a little lower than that right now, but you just get what you get. And if you hold it to maturity, you're made full, but it's not inflation protected unless you're getting into fancy ones with tips and everything else. But the insurance is there on the fact that you will be made whole if you hold it to maturity. And then looking at us, yes, you get a little bit of both, right? You get that monthly fixed. You're also getting some asset appreciation over time. And if you pick these well, and we plan to, obviously, and investors will have the opportunity to pick and choose which properties they like better and which locations and different variables, then obviously you can kind of have your expertise there shine in a way. But you do have some of that insurance there on the downside if things go south with the market or the area of the property. And it is kind of inflation protected, right? We can talk about for all day about the dollar and all kinds of macro issues, but I'll stay away from that for now. The historical returns versus REITs, I won't dig too far into this, but a REIT average return, you're looking at 11%. With us, the average return, hypothetically, since REIT data was available back in '87, you're looking at a 9.9 or close to 10% return average with us. Now the difference is we're going to kind of take that right tail and left tail and limit those years, right? So we're going to make it a little bit more of a stable and less volatile investment than a REIT, because you can have unbelievable years with REITs, and then you could have really, really tough down years. And if we can limit those left and right tail years, you're going to get a little bit more of stable return. So as you can see, a REIT total return would actually be less than a total return with us because of the building year over year and eliminating those really bad down years. So talking about the future, obviously tons of legalese here regarding the future. It is all hypothetical and forward looking. and based on us, delivering on what we anticipate we can deliver. So the investment market, or the real estate crowdfunding market, if you will, was 151 billion in 2021. That stands to grow exponentially. The projection here is by 2030, we're looking at 1.3 trillion. There's no shortage of investors, retail and all the way to institutional, that want to get exposure to real estate, especially with dollars devaluing. It's a physical asset, and tax benefits. And there's so many great reasons to get involved in real estate as an investment. But on the left side of this Venn diagram, you're going to see some of the people already in that space. Picasso was one of Zillow, or Spencer Rascoff, which was Zillow co-founder. Fundrise is popular, Roofstock, some of these others. There's no shortage of options for retail investors to try to get involved in some of this. And then you obviously have your REITs and other traditional options. But for buyers, there's really not a lot. Point and Home Tap are both reverse mortgage-esque. I know Unison's one of them. I think Kevin mentioned it yesterday. But those, you have to have a home, right? And then you can access some of your equity that way. House is an interesting one. It's a Silicon Valley startup, but they're more geared towards blockchain, and they're tokenizing and creating a fund, which you can get a piece of, but there's really no direct ownership in the asset. And hopefully we'd like to think that we solve for both those, right? We're making it better for buyers, and we're giving investors, direct ownership, something that is much more tangible than some fund that you're trusting other people with. And then our 3 points of revenue, there are more. Kyle is really creative and has so many good ideas of how we can use this going forward to generate revenue. But the three main ones with buyers, 1.5 points at closing. And again, because it's such a streamlined process, a lot of and it's a cash purchase, a lot of your expenses are going to be saved there already. Investors pay a 1.5% fee on every security. And then brokers, as they get their license to offer our product, will, I don't want to call it a kickback due to legal potential conflict there, but it basically will have a license that we offer brokers so that they can offer our product, right? We're helping buyers increase their buying power. That immediately affects brokers and makes their life a little bit easier and better.
Yeah, so I'm gonna step in here too, because I think that's important. The revenue streams here are immense. So on the buyer side, what we plan to do is, as Zillow's done, is if you are a listed referral agent, you have to pay a 30% referral fee back transaction through the system. The second most important thing is, because it's not a debt service, it's actually equity. There's no rules or regulation from consumer protection that doesn't allow us to use our own title company. So Listid will also have ownership in the title company, and there'll be a bolt-on acquisition for every single title company, which I'm already working on now. So they have to close the loans through our title company. They can use their own lawyer to run to actually handle the closing, but they'll have to close. It's just like a commercial bank where they have a list. Then there's a million other things you can do, as far as if you work with other financial institutions, other banks, right? There'll be some sort of points that are given back to us if we refer clients over to the bank. So there's a million different revenue streams that we have, just to kind of piggyback on that, Norman.
Yeah, I mean, the possibilities are endless. I don't want to get too far away. That's the exciting part, right? And I get excited about it, and Kyle does. I don't want to get too far away for your sake from this investment, because this investment is going to be very controlled. There's 20 to 40 properties. But I think if you're talking about your equity potentially in this company, the growth is really, really limitless, and different ways that we can structure things. And like he said, you could get your product, we can get our product in banks, right? So a bank might have somebody who wants to use this, and they originate it with the customer, and they also agree to buy the investment product. So there's all different ways this can go. But I'll try to stay grounded and a little bit humble here as we keep going forward. Just the basic breakdown per property, right? If $500,000 average property, we would bring in that 22.5, right? Our cost with The transfer agent and a couple of the other basics on the closing and stuff is about 5,500, and then that makes for about a margin of 17,000 per property, which is a pretty good margin. There are plenty of overhead and things to go over, but effectively, what that would mean in just terms of sheer revenue is all you need is a really small slice of this pie, right? So if we were to do 100 property, and to set the table, I guess about 5 million, that's kind of a conservative number of properties sold every year in the US, which is about 100,000 per state. And with 0.1% of share in one state, 1.7 million is nothing to scoff at. But then as you see, we can go from one state to branching out to different states and licensing out to other realtors in different regions, and that can grow pretty quickly. I won't bother you with the exact numbers. Obviously, you can see there. And then these again are projections for year 1 through 5, and I'll get a little bit more into detail. But 67 properties in year 1 we think is entirely doable, right? Our capital raise will get us somewhere between 20 and 40 right off the bat. And again, Kyle, like he said, there's no shortage of demand on the buyer side, and this will just be as fast as we can churn out that investment product on the back end is how fast we can do more properties. And a lot of the biggest concern from some of the people I spoke to at the institutional level, and we're talking about the highest, largest assets under management group in the world, they didn't believe that the buyers wanted this product. There were some that tried something similar to this, but the savings weren't the same because investors wanted a higher return, and they wanted that higher return because the shares weren't tradable. Since the shares are tradable and transferable, and you can realize that appreciation pretty quick, or at your disposal, basically they're willing to take a much lower fixed return due to that just very basic feature of tradability. I'll keep this moving. Here are the financial projections just so you can see, and we can come back to this when you guys have questions. And I have a finance degree from a million years ago, but this can be pretty boring stuff. And here's some basic assumptions that our financial projections are based on. Again, we can dig into that upon some questions. And just really quickly to close the structure here. So myself, my co-founder, is Zach Etten. He is director of marketing at a company in New Hampshire, and he was a college basketball teammate of mine. I've known him since we were 18, and obviously Kyle there on the right, who you guys know. But I played basketball with Kyle's younger brother, and the first time I talked to Kyle on the phone, I thought it was his younger brother. He was like, "Hey, man, I don't know who the heck you are." So it's kind of funny how things can fortuitously fall into place. But I really only recognized his name on a radio commercial because of having played hoops with his brother, and obviously worked out pretty well. So the last couple slides here, just the structure of this capital raise, right? So our listed C Corp is at the top there, and we are creating this LP with the purpose of raising this $10 million, and the capital raise investors, as you can see there in blue, are participating in the LP. The LP then owns a series LLC, which owns and operates each individual property. All right, so we are technically the owner of this series LLC, and each series within that series LLC has a buyer with 20%, and our LP takes the other 80%. Okay. And then as you see, we're going to take that 80% and kind of hand it off to these property investors who will take our place in those properties. And at that point is when we make the LP whole, and everybody gets their money back and some return on top of that. And then I think that's about it. Okay. Hopefully, well, that took a little longer than I'd hoped, but I imagine there are going to be some questions. Nope, Brian, I can't hear you.
No, great job. Just saying that was very quick and precise. I think that was good. Probably a lot of questions. So why don't you guys just raise your hand or unmute? I know Kevin had a question or two.
Yeah. So you're trading this in the secondary market, right? Can you tell me the incentives to buy this particular security versus like something else, I guess my loan gets sold in the secondary market, right? Maybe at 6%, 6.5%, but your security is trading at 3.5%. What incentive is there for institutional buyers to buy? Maybe I'm not getting it correctly. I understand it correctly.
No, I think you got it. There's that 3.5% is the fixed amount, right? That's that monthly payment that the buyer custodian of the property is going to make. On top of that, that security represents legal ownership in the property, right? We're going to appraise the property every year, right? And there's going to be another method which will help us get a sense of the value. But effectively, if the investor, the holder of that security, wants to realize or liquidate their share, they can go on a secondary market and sell it in year 2, right? The home doesn't have to be sold in order for them to realize that appreciation. So if the home value's gone up by 5% by year 2, they're going to get their 3.5% plus the 5%, which is 8.5.
Gotcha. Okay. Do you already have clients or institutional investors that are interested in the product? I think I heard that there's interest there. Okay.
Yeah, so I used to be a scout for the 76ers. Had a little celebration to myself last night when Joel Embiid won MVP. We drafted him back in 2014, I think it was, or 15. But anyways, one of the managing owners there was David Blitzer, and he's at one of the VPs at Blackstone, and they are one of the largest real estate owners and holders of real estate in the world. I took this idea to him long before we formed the company or any entity, and he kind of helped me with his partner there, Todd Hirsch, go through some of the basics. They tried to poke some holes in it, and they did, and they kind of answered their own questions and liked it. They backed a company called Home Shares about 15 years ago, and that's the one where I explained that it didn't save the buyers enough to make sense for them because the investors were demanding such a high return, right? And that point that you just made, Kevin, is that tradability gives the investors that flexibility where, okay, I don't need to demand such a guaranteed high return if I can, cash in on the appreciation when I feel like I want to. And so that's the main difference that we think will hopefully make this a success compared at least to that one. But Blackstone got behind that company 15 years ago. They basically told me, hey, go out, get this thing started, get it moving, and show us that you're competent and capable, and we'll get behind you in a big way and help you scale this thing, which is a huge relief, right? Like we can just focus on the details and getting this thing built right, and know that we'll have somebody there, hopefully, in the end that is at least interested, right? There's no guarantees. I don't want to get sued here by Blackstone, but the other thing is they also could be a customer of those securities, I think, which is part of your question, which is who's going to buy these things on the back end, right? There's 80% there that needs to be bought. So they obviously are very involved in real estate. They're going around over the last 2 years since COVID and just buying up neighborhoods and letting them sit empty, right? And there's a lot of this institutional demand for physical real estate, but they don't know what to do with it. It's costly to maneuver. And we think we kind of solve a little bit of that problem by, putting them in touch basically with somebody who wants to own and operate the property, right? And they're still going to get the benefit of owning it without having to do the day-to-day stuff.
I think one other answer to Kevin's question was why these securities would trade on the secondary market is you're dealing with a different buyer. So you're not dealing with that FHA buyer that has a greater ability to have a non-performing loan. These are going to be more astute clients in the beginning. And I think that's one of the key aspects here too, is as this grows, you're going to have a different buyer base. So that's important to keep in mind. It's more of a stability asset.
Right.
And the dividend payment should be much more stable.
Yeah, I don't want to sell this as a speculative, like, hey, you're going to get rich because real estate does well type of asset. People still buy bonds, believe it or not, and those are pretty low yielding assets, but there's some security in those, and that's why people buy them. And I think the fact that this isn't maybe as safe as that, but it's a physical asset, it's protected against some inflation, and can be treated like a bond, or at least has a place for a place in someone's portfolio who is looking for some stability with a shade of potential upside.
Just one more question is, there's really no principal paid on that share, correct? Because this is not really a debt.
Correct. So the breakdown stays the same. And if you want to overpay, what you'll do is instead of making your, let's call it $2,000 minimum payment, which will keep the breakdown the same, you could make a $3,000 payment, and that extra $1,000 will be clawing back some of that equity from those outstanding securities, right? And so that doesn't mean we have to buy them off the market. We can literally just adjust the amount of equity that they represent. And so that person who's holding them in their portfolio sees that, the principal has been lowered, but the same returns and same everything stays the same. So just they have, if it was a wholesale situation and somebody owned 80% in their portfolio somewhere, they would see that, hey, somebody overpaid, they've purchased back some of the principal, and that $1,000 would go to that investor who was holding it in their portfolio.
Hey, no, you can see the little hand raised there up in the corner. You feel free to pick on people that are raising their hand.
Oh, sure. Nelson?
Yeah, a couple questions. Why haven't other lending institutions offered this as an option to traditional financing?
Boy, I wish, I hope that the answer is they just haven't thought of it, right? I think part of it is that the mortgage industry is unbelievably lucrative, and there's so many middle entities, right, that thrive on the mortgage industry, and they're just focused on keeping their head down on churning out as many originations as possible. I just think it's not as profitable to them. And to be honest, like we didn't formulate this in order to say like, oh my gosh, we could make a killing. It was like, let's solve the problem, and then I'm sure we'll find a way to monetize it after the fact, right? So hopefully we're solving the problem, which isn't necessarily always mortgage originators' goal, right? Everything's compartmentalized.
Yeah, you're solving problems for the investor, right? Which is that cash flow on their properties as a portion of their portfolio. Right. And later on, if you get to the actual people who live in the homes, you're helping them with their mortgage payment, as long as they don't care about long-term the equity, with the option even to buy it down if they want to.
Right. And I think banks just, they don't want to own these assets to begin with. They don't want to foreclose on these houses and own the equity. They're not investors per se. That's not what they do.
That later on? Haven't banks
some portions? Yes.
The other part too, though, guys, that you really need to keep in mind is at the end of the day, the real estate industry within itself is a very archaic space, right? And what I mean by that is if you think about real estate agents, that game really hasn't changed, right? There's still an agent that shows the house. If you think of mortgages, that game really hasn't changed. So it's really not very innovative and changing. So I think this is just a different way to look at it. You're starting to see the Grant Cardones of the world that are offering syndication stuff and whatnot, but that's totally different. So it's just a function of, really, really becoming a little more innovative in the space. And I think no one really has brought it to fruition.
Yeah, it's great. And I got to bounce here in a minute, guys, but if I've got some introductions for you guys, Kyle, do I send them to you, or what email should I send introductions for? I got a couple of guys I want to introduce you guys to.
That's awesome. My email is norman@listid.us. I can, if you go to the website, actually, you can just do like a little contact us box, and that would go to my email too. So
send it to me too.
Send it, copy you as well, Kyle.
Yeah, put me on them. If you can, please.
Yep, I will. I've got a couple guys in mind that
all right,
awesome.
Different angles of this that might be investors as well as another model to it. So
fantastic.
Cool. I got to go, guys, but appreciate it. Very, very informative.
Thanks, Nelson.
No,
okay. Go ahead, Brian. Sorry.
Yeah, just one question that I thought I saw somewhere that if we invest in this, it looked like it said there's a 5-year window for returns. And then is that it, or is it a lifetime holding?
That was just what we projected out. But it would, let's see, the equity is a lifetime holding, right? That's a simple agreement for future equity. Just the projections, we stopped at year 5 because it seems a little bit.
Okay, so it's a holding that we have as long as the company does well or has an exit.
Correct.
Is there any other way other than an exit for us to either sell, or let's say 10 years into this, we want to kind of liquidate this investment? Is there a vehicle for that? I
don't think so. I think there needs to be a liquidation event. I don't want to shut that out and say no. I will definitely ask the lawyers on that. I don't think if you participate in this and you receive a safe agreement, I don't think you can transfer those.
Okay.
You'd have to hold that.
You're making everybody whole in about a year anyway, projected. So it's
Right.
just a question. So it's more a matter of the simple thing is you invest in something that projected to get your money within 6 months or a year if all goes well. And then you have this, as long as you guys are alive and thriving, you're making, is it annual or quarterly type distributions?
Monthly.
Monthly, okay. And then if
Yep.
there's exit of the whole company, everybody, based on the percentages, participates in the exit.
Exactly.
Yeah, so it's a cash flow plus an exit, plus a return of your money.
Right.
Okay.
Right. I think there's a hand raised. Is that Ara?
Yes,
Yep.
I know.
How you doing?
Good and you. Great presentation. Thank you.
Thank you.
I didn't expect any less from you. So few questions from both sides as an investor and as a quote unquote borrower. Not borrower, I'm sorry. Home purchaser, the other side of the coin. What is, as an investor, what is the entry? If you said it, I apologize, I missed it. What's the entry limit, minimum for investors?
So right now we have the minimum set at 100,000.
Okay.
That kind of, we wanted to keep it. So if we do get to the 10 million, it keeps the numbers kind of down a little bit. We don't want to make this too broadly open, but yeah, 100,000.
Also, I apologize. My camera's not turning on. So
no problem.
The next question: is there a limit on the acquisition dollar amount limit from your side? You 80 or 90%?
On an individual property?
Yep.
We didn't set a limit, although I think in the legal documents it says something about like a $2.5 million maximum, but these are going to be average $500,000 to $1 million properties. Again, we're focusing early on multifamilies, probably 2 to 4 family, things that cash flow pretty well. In that Kyle has, an abundance of people who are like ready to go yesterday. And that seems to be the sweet spot between 500 to $1 million. And yeah, that's what we're going for.
You're familiar with Massachusetts, 500 to $1 million will get you.
Yeah, that's not gonna just on that, Norm. I think with that,
go
with
ahead.
values where they are, where values where they went now, I mean that number's gonna go much higher, and I don't think we really care on the first 20 or 40, how we fill them as long as we fill them. So goal is just fill the slot of allotted funds and keep moving on. But I think when we first talked a while ago was, ideally a lot of Rhode Island stuff was like, 500 million got you between 6 and 10 units. In Mass, you're not getting that.
Yeah.
Kyle,
You can see why I defer to Kyle on pretty much all things real estate. I am just a finance guy.
That's correct.
Next week we definitely need to do what we're supposed to do this week, get together. The next big question is, so let's say I purchase 5 houses or whatever, a house and $500,000, put down 100,000, 400,000 is financed by you guys. 5 years down the line or 2 years down the line, I want to sell that house. I'm still 100% operating it and managing. I can get out of that house without permission from you, correct?
Yes, you have the right to say when you want to sell it. There is an expiration. We set the expiration at 5 years, and at the 5-year point, you can either renew on a new 5 years and extend it, but it would reset at the current rate of the 10-year yield. So this could continue on beyond 5 years, but there is a 5-year window where either you before then or at that point in time, you either sell it. You could buy it all the way from us with traditional financing or cash or whatever you want to do, or you could extend it for an additional 5 years.
So even if you sold this asset on the secondary market, you're still servicing it, quote unquote, using conventional mortgage language, correct?
No, we're not servicing it. So we would provide that 80% in cash, right? And that's really what this capital raise is going to be used for, is to get these first 25 properties or so financed and underwritten. So we're not using any leverage on the back end. When we scale down the road, we'll probably set up a credit facility, so we can churn these out a lot faster, but no leverage.
Okay, but if you're secondary market, if you're selling the secondary market, who am I writing the check to next month when you sell
Oh, you go onto our portal, right? Are you talking about with the monthly payment?
Yes.
Yeah, the monthly payment, you log into the portal, you pay your $2,000, and our transfer agent automatically disperses it to anybody who holds one of those shares.
For your servicing, basically, in the old world.
Yes.
Okay. Perfect. I'm very much interested. Kyle, we need to get together with Eric, you and I next week. Definitely.
Awesome. Thank you.
Thank you.
For sure.
Looks like Michael has his hand up too.
Oh, sorry. Michael.
Hi there. Sorry about that. Just wondered if you can use self-directed IRA funds to invest the 100K plus.
There is that in the subscription agreement, and we left it in there. I do believe that's possible. I'm like 90% on that.
Yes, I saw that in there. Yes, it is. You can do that.
Okay, that was it.
Awesome. Oh, Matt.
Norman, real quick, thank you for this presentation. This is a great idea.
Thanks.
So, yeah, absolutely. So it seems that as far as this is not going to be a product that would be offered to, as far as an actual buyer looking to go, they would say, hey, I found this property at 123 Main Street. These properties are basically being sourced by Kyle and Kyle's team.
The initial ones, yes. So this
Okay.
LP that you'd be participating in would be super controlled, right? But you're also getting some equity in the company, right? And I want to make sure that you see the potential down the road. So hypothetically, yes, a buyer could, and you could do it tonight if you go on our mobile app. You could literally just pick out whichever house you want on the market and say what you would put down for a down payment, and you would see what your monthly payment would come out to with us, and you'd submit it, and then we could evaluate your credit, evaluate whether or not that's something we want to underwrite. But hypothetically down the road, yes.
So
But
as
on
far
that
as
point, Matt, on that point, if you do, like, let's say you're an agent and, well, let's say I say, hey, Norm, let's just try to get as many deals as we can as fast as we can. Matt is an agent. He ends up bringing a buyer to the company. At that point, I would pay a referral fee to you. It would probably be a 50-50 on the buyers, or you would pay me rather a 50% buyer referral fee on the agreement. That's just the way, just so that I'm involved and make sure that these first 20 or 40 are really on point.
Kyle, you're the man, so of course everything's going your way. That's everyone trusts you on this, so that's not a question. So when you said, if I wanted to go into the mobile app right now and apply, just hypothetically, these are properties that what you're looking to start off with is going to be sourced by Kyle, and of course he's going to bring you everything that's amazing.
Yes.
So if I found something on the open market that maybe in my market in Massachusetts, would you guys analyze that deal to make sure that that's something good, or it's only properties that you guys identify?
No, we would analyze it for sure. I mean, especially you could you send me an email or Kyle a text, like we'll make it work, right? But hypothetically, we're probably only going to trust people that Kyle has relationships with. Obviously, you're on this call. You're certainly somebody in that group. But yeah, if you found something you wanted to do, we would definitely analyze it. And yeah, for sure.
Okay, awesome. Thanks, guys.
I'm
Appreciate it.
also in Massachusetts. I'm up here in Newton Wellesley area right now, but I'm originally from New Bedford. Where are you at, Matt?
I'm in Lunenburg right now, North Central.
Oh, cool.
Mass. Yeah.
Cool.
Looks like Dave has a question.
Sure, Dave.
Sure. Well, first of all, thanks for the prezo. Yeah, a couple of questions. First, how many homes have you purchased using this model? I think I know the answer, but I wanted to be certain.
0.
Okay. What is proprietary about what you're doing?
So we are going to file for a patent on the back end with the transfer agent aspect. So technically, people have been partnering on properties for a long time. The only proprietary aspect that we think we have a chance of getting is the adjustable equity, meaning when you miss a payment, that equity that you would have, that dollar value that you missed is automatically reducing your equity and increasing the equity of the shareholders or the people that are owning the securities in the back end. We think that's unique enough where we could possibly get a patent on that. Other than that, I would love to tell you that this is, revolutionary stuff that like only we can do, but that's not the case.
Okay. Is there a fractional component? Is this going to be a fractional investing model?
Yes.
And you're raising $10 million for 10%, correct?
Correct.
So you're valuing this at its very beginning at $100 million. That's what you're asking
Well,
people to step
that's
up.
that's technically the valuation cap, but because we're returning the capital immediately, it doesn't feel necessarily like, you know, you've put out this money and now you get this 10% and that's all you have back, right? If you were to get the money back, it's not quite a traditional startup investment. So I think that's the reason why we went with the aggressive cap. And again, it's a safe, so simple agreement for future equity. It doesn't mean that you own it now. It's whenever the liquidation event or Series A or whatever you want to call it takes place.
Okay. Are there any noteworthy strategic investors that have said yes?
So we have exactly $0 officially invested. So that's the correct answer. The exciting answer is everybody from Blackstone to my uncle was the president of TD Ameritrade retail. Everybody that we've run this by has said, you get on the scoreboard and, you know, we'll get involved, right? Nobody wants to be the first one. We understand that. And that's why, you know, Kyle was like excited about getting in front of this group and Brian was obviously really cool enough to help us organize this tonight. But this is super early. We haven't even opened the LP offering yet officially. I think that's going to be this week. And so technically it's $0 because we haven't opened it yet.
We just finished, Norman. I think it's important to note that we just literally finished last week. Like we haven't even had a conversation with anyone since the pitch deck's been done.
Right.
So this is really the first group we've spoken with. We do have Josh Altman that we talked to in the past that said he was very interested in putting up a significant capital. And then I have a couple folks that in my small network that are very well off that are interested, but we haven't even brought this to the public yet. I mean, this is just the first people we talk to.
Exactly. I don't want to get too excited and throw names at you, but again, like Josh Altman, the $1 million listing guy in California, he's from Newton, Mass. We connected. He was like ready to do it yesterday. And then he was like, all right, well, get the legal stuff together. So we will circle back with him. I'm going to talk to Chris Paul the second that the Suns get bounced out of the playoffs. I, again, have I'm currently an NBA scout. I didn't really give you a whole background on myself, but tons of people within the NBA world who we've spoken to who said, yeah, let's get involved. Let's do something. But like Kyle said, this is super early. We just finished all the legal documents literally last week and got everything ready to go. So.
Got it. Last question I had, and then I'll shut up. What are your expectations or projections about what's going to happen in real estate in the next 12, 24 months while you're doing this?
Don't even touch that, Norm. Don't even touch that. I'm at my daughter's softball game, so if you hear cheerleading in the back, it's her. It's the team. I
do want to answer that, but go ahead, Kyle.
You can, and I'll tell you from my perspective, and I know, David, you have obviously the finger on the pulse, and you know this game in and out as well. I think supply constraints for a majority of the country continue to be a major issue. I think that bottleneck does not go away or subside anytime soon. I feel like at the end of the day, interest rates will stabilize between 5% and 6%. Whether that happens at the end of this year or the second half of next year, but I think the public generally is behind, and supply will not probably come back on the market for another 12 to 18 months. I think foreclosures will remain low as values remain relatively high. And I think overall it's as much as I want to say it's a healthy market, valuations have got ahead of themselves. And I think we've plateaued at some point, and over time we may see some sort of depreciation down the road. But right now in the near 12 to 18 months, I think we're pretty stable as far as values go, unless we see some major economic downturn that impacts supply on a negative.
Dave, I feel like I have at least a grasp on your outlook, and I pretty much agree entirely. I am not necessarily a doomsdayer, but I see some serious financial headwinds in the future, really on our doorstep and are already taking place in slow motion. But it's ironic, today's a Fed day, right? They hiked by a quarter point, maybe the last one, and we're at the terminal 5.25 or whatever it ends up being. But here, my bigger concern is this: everybody, when everybody kind of thinks that the market's going to do a certain thing, and I'm not saying everybody thinks that the real estate market's going to crash, but usually when the majority of participants think something's going to happen, the market finds a way not to do that thing. And what I'm more concerned about is that this plateau that you're seeing in prices right now is the crash, meaning in real value, homes are devaluing, right? And the nominal dollar value, because we're measuring it in dollars, is staying the same. And it looks like it's a plateau when in real terms, if you were to measure it in gold or commodities or something other than US dollars, which are devaluing, I think this might be a correction, and we're all waiting for it to happen, and it's happening, and we're all going to miss it. And then what's going to happen is, because the government has kind of explicitly said, we're not going to let this asset class devalue as we saw in 2008, and we reinflated the bubble, and we can blame the Fed or we can blame politicians, whatever you want to do. But I fear that when there's a bubble and one party says we're not going to let it correct itself in one direction, the only other option is the other direction. And I fear that these prices will go through the roof because of inflation and because of the devaluation of the dollar. But I completely sympathize with the idea that a major correction probably needs to happen. It might be underway as we speak. And that's one thought.
Got it. Thank you.
And I should say also that, if there is a major correction, institutions and buyers are going to want a very streamlined, efficient way to buy up more real estate, right? If this is the bottom in 2008 or 2009, or whenever it does come about, people are going to want a very streamlined, efficient way where they can get on and just, purchase these physical assets without having to go down there and buy up these things in person. And I think we might fit that need on an institutional level or on a professional buyer level.
I was going to
On the website, you said that you said on the app, but on the website, is there a way of finding out what Kyle has chosen for tranche or first tranche? Because when I went to Middlesex County, I mean, we're looking at $16 million houses, $14 million houses, Wellesley, Mass. Is there something that the $500,000 range that you guys have chosen?
Yeah, if you're on your desktop or even if you're on your mobile, there should be a setting there where you can set the price of what you want to look for, and it should filter right down to that price range.
Regretfully, there isn't. All it is browse properties and then choose the area. I'd say Middlesex County, and I'd say go. There is no price range. It starts.
So all that is, Ara, all that is an MLS IDX that feeds directly to our site. So basically what we've done is we've taken all the MLS data and we can update the site or whatever. It just feeds it in there. It's almost like a Zillow platform. And then what it does is it allows you, based upon what you put down, it allows you to see what the payment is. So the average person can go in there. And one of the problems that Zillow has is when you go on Zillow and you put in, you want to look for a house or whatever, it gives you this payment that's not true. Whereas our number is going to be actually the situation, what the payment will be, because it doesn't include tax and insurance. It's just going to include your dividend payment. So we can talk about that and fix that tech side of things. But more if you're in Rhode Island and you look in the Rhode Island spot, just put in an address and then type how much you want, or filter over how much you want to put down. It'll tell you what the payment is. And then it will usually compares it to what a conventional loan would be.
Yeah,
I'm happy to meet with you individually or email back and forth and get you on that. But if you eventually scroll down, you would get through all of the listings, and that's pretty much everything that's on the market since we updated it.
Okay, we'll take this offline.
Michael?
Just, I hope you haven't already answered this, but say you've got a buyer, he puts in 20%, Listid puts in 80%, and then 2 years later, the buyer wants to get out of this thing. I don't know, refinance or sell it, or what's the mechanism? How does that work?
No problem at all. You can sell it or refinance. There's no holdback. There's no tie up. There's no prepayment penalty. You can go ahead and refinance with a conventional loan. you can go ahead and sell the property, but you only will receive the percentage that you have in equity on the upside. For example, if the equity percentage you have is 20% and you sell it and make 100,000, you will get 20,000 and the investors will get the other 80,000. But
And
you
on
get
a-
the whole cash flow.
Right. And on a refinance, you would Listed would be paid off so that
Yeah,
I
you
would
could buy.
Off
You,
the 80. Yep.
yeah, you could buy us out.
Okay. All right, cool.
Kevin?
Any fees on that? I know you just said no prepayment penalty, but any?
No.
Okay, cool. Thanks.
Kev?
Yeah, so two questions. Number one is, so I guess you're an owner, 80% owner, and when it comes to owning a property, there's responsibilities that's associated with it, like paying the utilities, trash, garbage, and all that. So you're dealing with, I guess, an investor owner. How is that going to be worked out between you or listed and the investor owner?
Sure. Part of it is
80% of it, the expenses.
exactly.
And is there going to be an agreement that is going to lay out like everything in terms of expenses with the property is concerned?
Yes, all that language is legally covered. But in short, the answer is you will participate proportionally, right? So if we will set the threshold, let's call it $2,500, right? If there's an improvement you want to make to the home or an expense or something that happens that's not covered by insurance, if it's over 2,500 and it meets our approved list and we look at it and we say, this is good to go, then when you participate in that, you would fund your 20%. The holders of the security would have the option to participate. If they do participate, their equity stays the same. If they don't participate, your investment in that project will now be purchasing some of that equity back from those people who didn't participate, if that makes sense. So let's say
the
it's 80.
important part that he's saying, Norm, important that he's saying is who pays for the trash, the water, the sewer. That goes on the consumer. So that goes on the
Yes.
investor that comes in at the 5 or 20%. They're responsible just as if they had a mortgage for 20% down. They are the actual one responsible for the day-to-day and all the stuff that takes place for that.
Yeah, that's great.
Correct.
I mean, that makes it easier for investors like us. The other question is, let's say, hey, going back to your example, I want to pay $1,000 more every month.
Mhm.
How do you equate that to like the equity that I'm buying back? Because every time when that happens, right, don't you need to do an appraisal or some sort of BPO in order
Yes.
to realize the value at that current point in time? And
Correct.
it's
So
kind of like difficult to do because the value changes all the time, right?
It would most likely be done
Yes.
annually, though. It wouldn't be.
It'll
It
be-
wouldn't be like a annual. It would be an annual BPO.
Correct. It won't be, perfect down to the day, right? But we will reappraise the home every year. And what happens is if there's transactions on the market, then we get a valuation in between there, right? If somebody were to sell one security or two securities, whatever, we get a price. But effectively, to answer your question, as the home goes up, right, that $1,000 is going to buy less and less back, right? So if you overpay, it's in the beginning, you might be getting more equity back from the security holders than you would if you wait till, year 5 or whatever it is. I'm trying to think if I think that answers it.
Got you. And the same mechanisms that like the lenders have to enforce that the borrower actually pays for property taxes and make sure that there's insurance in place. Is that going to be the same with Listid?
We would copy that. We would copy that.
We would do it because we're technically the owner. So the series is the one that is responsible for paying. We're passing that on to the buyer, right? If you're the buyer in the home, it's included in that payment, right? So even with those savings, that includes the tax and insurance, but we would be responsible for paying. And if you missed a couple of payments, that equity would be redistributed.
Got you. Thank you.
Yep.
Norm, I told you this would be a good group.
Yeah, absolutely. Excellent question. Seriously.
Yeah, it's that's why I wanted most of these guys on. Is real estate's not my expertise, and a lot of these guys it is. So that's why you're getting some of these granular questions. But it's good.
Yeah, absolutely. Yeah, I appreciate everybody. Even every question, helps us learn and try to figure out where the pressure points are and the friction and what we need to clarify, and helps us grow.
Very cool. Any other questions, guys? I know we're running a little long. Let's see any more hands up.
Great stuff. Thank you.
Yeah, no problem. Thank you.
Awesome.
Thank
Well,
you, guys.
I'll get your info. Everybody here knows how to get a hold of Kyle anyway. If you have any interested in investor docs and more questions, just feel free to reach directly out to them. And yeah, thanks for presenting this. And hopefully, like I said, it helps you sharpen up your pitch and get you a couple of reps in,
Yeah, absolutely.
Yeah,
I need some work.
Michael?
When's the money due? Like, when do you start collecting? And is there a closeout?
So we're
time?
gonna open it up next week. There's a button right on our website that says invest. That's not technically live. It'll take you to the transfer agent's portal where you will hypothetically invest, hopefully by next week. But it's open for the foreseeable future until we get there. All right.
Very cool. All right, gentlemen. Thank you very much for
Thanks,
presenting that. Anything else comes up, guys, let us know, and you know how to proceed if you choose to.
Awesome. Thank you guys for coming, and appreciate the questions, and Godspeed.
All right, guys.
Good night,
Take care.
All right.